we will explore option pricing, focusing on one of the most renowned mathematical formulas in finance, the Black-Scholes formula. Before diving into the intricacies of this formula, I would like to present a classical case study in investment risk management. The hedge fund Long-Term Capital Management, LTCM, was founded by the creators of the Black-Scholes formula. Despite their expertise, LTCM employed extremely high leverage and was exposed to significant market volatility. These factors ultimately led to the fund's collapse. This case study underscores the critical importance of risk management. Even the most sophisticated models have limitations and inherent risks, which can undermine confidence if not properly managed. Now let's talk about the Black-Scholes formula, which is a popular method for determining the price of a European call option. Let's break it down in simple terms. First, imagine you have an option to buy a stock at a specific price in the future. The Black-Scholes formula helps us figure out how much that option is worth today. I'm gonna look at call option. The formula on the top of this page. Here's how it works. You can think about the first part of the formula as an asset value to option holder. Think of this as the positive side of the formula. It represents how valuable the option is based on the current price of the stock. If the stock price goes up, the value of your option also goes up. This is because if the stock price is higher, you're getting a better deal if you buy it at the strike price. The second part of the formula is kind of liability value. Now, on the flip side, this is the cost part of the formula. It accounts for the price you'd need to pay if you decide to use the option. We also consider the time value of money, meaning we adjust this future cost to what it's worth today. If the strike price or the interest rate goes up, the option's value decreases. Then let's look at the key inputs to the call option formula. The first input is stock price. This is the current price of the stock. If this price increases, your option becomes more valuable because you can buy the stock cheaper with the option. The second input is volatility. This measures how much the stock price is expected to fluctuate. Higher volatility means the stock price can change a lot, making the option more valuable because there's a greater chance it will be profitable. Risk-free interest rate is also an input to Black-Scholes formula. This is the return you'd get from a safe investment, like a government bond. If this rate is higher, the value of your option goes up because the cost of paying the strike price in the future is less in today's terms. Strike price is also called exercise price. This is the price you'll pay to buy the stock with the option. If this price goes up, the value of your option goes down because it's less attractive to buy the stock at a higher price. The last input to Black-Scholes model is time to maturity. This is how long you have until the option expires. More time generally makes the option more valuable because there's more opportunity for the stock price to move and potentially become profitable. Now let's discuss the effects of changes. If the stock price goes up, the option value increases. If volatility goes up, the option value increases because there's a higher chance for profit. If the strike price or the interest rate changes, the value of the option adjusts accordingly. More time until expiration usually means a higher option value since there's more chance for price movement. In summary, the Black formula is all about balancing these factors to determine the fair price of a call option. It's a powerful tool used in finance to help with decision-making and risk management. Alright, let's make sense of some key points about options and how they work using the Black-Scholes formula. 1. Owning a call option. Asterisk imagine owning one call option is like holding a certain number of shares in a stock. The exact number is determined by a value called delta. In plain language, delta tells us how much the price of the option changes with the stock price. Plus, to balance things out, you might need to sell some shares of a special kind of bond that doesn't pay interest, called a zero-coupon bond. 2. Owning a put option. Asterisk owning one put option is a bit different. It's like you're short selling a number of shares, with the amount again defined by delta. But this time it's negative. To cover your position, you'll buy some shares of the same zero-coupon bond mentioned before. 3. Being long on a call option. Asterisk when you own a call option, you're in a favorable position with several things. Asterisk delta. You benefit when the stock price goes up. Asterisk gamma. This shows how delta changes as the stock price moves. And you're also benefiting from this. Asterisk vega. This tells us how much you gain if there's more volatility in the stock price. Asterisk theta. However, you're at a disadvantage here because theta represents the time decay of the option's value as it gets closer to expiration. 4. Being long on a put option. Asterisk owning a put option means, asterisk delta. You're in a position where you benefit when the stock price goes down, but this time it's a negative position. Asterisk gamma. You're still benefiting from changes in delta as the stock price moves. Asterisk vega. You gain if the stock price becomes more volatile. Asterisk theta. Like with call options, you face a disadvantage here because the value of the option decreases over time. 5. Owning an at-the-money straddle. Asterisk if you hold an at-the-money straddle, you're in a neutral position with delta, meaning you're not really affected by the stock price moving up or down. However, you still benefit from asterisk gamma. As the stock price changes, you benefit from the way delta adjusts. Asterisk vega. More volatility is beneficial. Asterisk theta. Again, you're at a disadvantage as time passes because the value of your options decreases. 6. Short option positions. Asterisk if you're on the other side, meaning you're short options. Just reverse what we talked about. You'd have the opposite exposure and risk profile compared to holding the options. Let's dive into payoff functions and visualize their shapes for call options, put options, and straddles. Visualizing payoff functions. 1. Call option payoff. Asterisk out of the money. Picture this. If the stock price is below the strike price of a call option, the option is out of the money. This means the payoff function is flat at zero in this region because you wouldn't want to buy the stock at a higher price than it's worth. Asterisk at the money. When the stock price equals the strike price, the call option is at the money. Here, the payoff starts to increase linearly. The function shows a straight upward line as the stock price starts to exceed the strike price. Asterisk in the money. As the stock price rises above the strike price, the call option is in the money. The payoff function continues to rise linearly, reflecting the increased value of the option as the stock price grows further above the strike price. 2. Put option payoff. Asterisk out of the money. For a put option, if the stock price is above the strike price, the option is out of the money. The payoff function remains flat at zero because there's no benefit to selling the stock at a lower price than its current value. Asterisk at the money. When the stock price equals the strike price, the put option is at the money. The payoff function starts to slope downward. As the stock price falls below the strike price, the payoff begins to increase. Asterisk in the money. If the stock price is below the strike price, the put option is in the money. The payoff function continues to rise as the stock price decreases further. This reflects the increasing value of being able to sell the stock at a higher strike price than the current market price. 3. Straddle payoff. Asterisk combination of call and put. An at-the-money straddle involves holding both a call and a put option with the same strike price and expiration date. The payoff function is a combination of the call and put payoff functions. Asterisk at the money, the function has a V-shape. It is flat at the strike price but increases significantly as the stock price moves away from the strike price in either direction, reflecting the combined benefit of both options. Asterisk out of the money and in the money, whether the stock price goes up or down, the straddle's payoff increases. This is because you benefit from large price movements in either direction. Understanding delta and gamma from payoff functions, asterisk delta, this is essentially the slope of the payoff function. For a call option, delta is positive and represents how much the option's value changes with a small change in the stock price. For a put option, delta is negative, showing how the option's value decreases as the stock price increases. In the payoff function, a steeper slope indicates a higher delta. Asterisk gamma. Gamma measures the curvature or how the delta changes as the stock price moves. In the payoff function, this is seen in the curvature. For options that are deep in the money or out of the money, the function tends to be less curved. Near the strike price, where the function bends more sharply, gamma is higher, reflecting larger changes in delta. By visualizing these payoff functions, you can get a clear sense of how the value of different options behaves with stock price changes and how the Greek metrics, delta and gamma, play into these dynamics. Finally, let's break down these factors affecting option values in a way that's easy to understand. Understanding factors affecting option prices for call options. 1. Change in stock price. Asterisk imagine you have a ticket that allows you to buy a stock at a fixed price. If the stock price goes up, your ticket becomes more valuable because you can buy the stock for less than its current market price. So, as the stock price increases, the value of your call option goes up too. 2. Change in stock volatility. Asterisk think of volatility as the amount of movement or swings in the stock price. If the stock price is bouncing around a lot, there's a higher chance that it will go above the strike price of your call option. This makes the option more valuable, so the more volatile the stock, the higher the call option's value. 3. Time decay. Asterisk as time passes and the option gets closer to its expiration date, it becomes less valuable. This is because there's less time for the stock price to move above the strike price. So, with each passing day, the call option loses value if the stock price hasn't changed. 4. Interest rates. Asterisk when interest rates go up, the cost of holding money goes up. This makes the ability to buy a stock later with a call option more valuable because you're effectively locking in a better price now compared to paying more later. Thus, higher interest rates increase the value of call options. 5. Dividend payments. Asterisk dividends are like a reward paid out by the company. When a company pays a dividend, the stock price usually drops by the amount of the dividend. For call options, this means the option becomes less valuable because the stock price drops, making it less attractive to buy the stock at the strike price. So, higher dividends decrease the value of call options. For put options, 1. Change in stock price. Asterisk if you have a ticket that allows you to sell a stock at a fixed price and the stock price goes up, your ticket becomes less valuable because you can now sell the stock for less than the current market price. So, as the stock price increases, the value of your put option decreases. 2. Change in stock volatility. Asterisk just like with call options, if the stock price is very volatile, there's a higher chance it will drop below your strike price. This makes your put option more valuable because you can sell the stock at a higher price than its market value. Thus, more volatility increases the value of put options. 3. Time decay. Asterisk similar to call options, as time moves closer to the expiration date, the put option loses value. There's less time for the stock price to fall below the strike price, making the option less valuable as expiration approaches. 4. Interest rates. Asterisk higher interest rates decrease the value of put options. This is because the present value of receiving the strike price in the future is less valuable when interest rates are high. Therefore, put options are worth less when interest rates rise. 5. Dividend payments. Asterisk for put options. Higher dividends are beneficial because they often cause the stock price to drop. If the stock price falls, the value of your put option increases since you can sell the stock at a higher strike price compared to the lower market price.